All right, you're about to make one of the biggest financial decisions of your life. You're scrolling through mortgage offers, eyes glazing over at all the percentages and fees, and then you see it, a tracker mortgage that looks way cheaper than all the others. It's incredibly tempting, almost too good to be true. And that's because that low rate isn't locked in. It's a living number, tied directly to the economic health of the entire UK. This means a single news announcement, a single decision made in a boardroom at the Bank of England, can either save you a fortune or cost you dearly. It could add hundreds of pounds to your monthly payment overnight or free up cash you never knew you had. So the big question, especially right now in the autumn of 2025, is this: should you take that gamble? In this video, we're going to demystify the tracker mortgage. We'll show you exactly how it works, how it connects to everything from inflation to global events, and give you the tools to decide if this high-stakes choice is the right one for you. Before we get to the wild ride, let's cover the basics. So, what is a tracker mortgage? Put simply, it's a type of variable rate loan. But instead of the lender deciding your interest rate on a whim, it tracks an external benchmark. For pretty much every tracker in the UK, that benchmark is the Bank of England's base rate. Think of the base rate as the master interest rate for the whole country. The Bank of England uses it to manage the economy and control inflation. Your mortgage deal is then set as the base rate, plus a little extra for the lender. That bit is called the margin. Let's make that real. Imagine, as of mid-September 2025, the Bank of England base rate is 4%. A lender might offer you a tracker mortgage of base rate plus 1%. That means your interest rate would be 5%, 4% plus 1%. Now here's the key part. The Bank of England's committee meets roughly every 6 weeks to review this rate. If they decide to cut the base rate to, say, 3.75%, your mortgage rate automatically drops with it. Your new rate would be 4.75%, 3.75% plus 1%, and your monthly payment would fall to around $1,043. You just saved $30 a month without lifting a finger. Simple, right? But remember, this is a two-way street. To really get a feel for the stakes, let's imagine you're a first-time buyer with a new tracker mortgage. We'll follow your money down two very different paths. You've just bought your first flat. You went for a tracker because the initial rate was lower than the fixed-rate deals, giving you some much-needed breathing room in your budget. A few months in, the news is good. The economy is stable, and inflation is cooling off faster than expected. One Thursday morning, a notification pops up on your phone. Bank of England cuts base rate by 0.25%. A few weeks later, a letter from your mortgage lender arrives. It's not a bill. It's good news, confirming your interest rate and monthly payment are going down. Your payment is now $50 lower. At first, it doesn't feel like life-changing money, but then you do the math. That's an extra $600 a year. That's a weekend away, a new sofa, or a serious boost to your savings. A few months later, it happens again. Another small cut. Now you're saving $100 a month compared to when you started. This is the tracker mortgage dream. You're benefiting directly from a healthy economy. While your friends on fixed rates are still paying the same higher rate they locked in months ago, you're paying less. You feel savvy, like you've played the system and won. Even better, many tracker mortgages have flexible terms with no hefty penalties for overpaying or moving, though you should always check the fine print for your specific deal. This is the reward. Okay, let's hit rewind and take the other path. Same flat, same tracker mortgage. But this time, the economic winds are blowing the wrong way. Global events have caused energy prices to spike, and UK inflation, which seemed under control, is creeping back up. You start seeing the headlines. Inflation remains stubbornly high at 3.8%, a number well above the bank's 2% target. Financial news is filled with talk of the bank needing to cool the economy. You know exactly what that means. At the next meeting, the Bank of England raises the base rate by 0.25%. The letter you get from your lender this time feels very different. It informs you that your payment is increasing by $60 next month. It's a stretch, but you can manage it by cutting back on a few subscriptions and takeaways. But the inflation problem persists. 2 meetings later, the bank acts again, with another 0.25% hike. This is the harsh reality of the tracker. The cheap deal you started with is now more expensive than the fixed rates you originally turned down, and you're left wondering if the initial savings were worth the stress. The face-off, tracker versus the fixed-rate fortress. So if a tracker is a roller coaster, what's the alternative? It's the one you see everywhere, the fixed-rate mortgage. Think of this as setting your mortgage payment in stone for a set period, usually 2, 3, 5, or even 10 years. No matter what the Bank of England does or how chaotic the economy gets, your core monthly payment will not change. Let's put them side by side. The case for the tracker mortgage advantages. Trackers are transparent. Unlike some other types of variable rate mortgage, with a tracker you know exactly where you stand, thanks to the relationship between pay rate and index. Tracker deals typically do not have early repayment charges, ERCs, so there is no penalty for leaving early. This can make it easier to remortgage if you spot another deal you would like to secure. Rates can be cheaper than fixed-rate deals if other factors push up lenders' prices. Rates are generally lower than an SVR. Disadvantages. You need to be comfortable with fluctuating interest rates and the effect they'll have on your mortgage bills. Trackers are not suitable for nervous borrowers who cannot cope with potential increases. The total amount you pay each month could change, and it can go up. This is not great for those on a budget. You don't get the security that you would with a fix. You may not be able to borrow as high a loan amount as you could with a longer fix. If your deal has a collar set at your initial interest rate, you don't stand to benefit if the base rate goes down. Tracker mortgage versus fixed-rate mortgage. The rate of mortgage interest could fluctuate several times a year with a tracker. With a fix, the interest rate remains the same for the duration of the term. If you opt for a tracker, you need to be comfortable with the possibility of your monthly repayments varying. With a fix, you get the peace of mind of knowing exactly what they will be for the duration of the deal. You might be able to get a cheaper rate for a tracker than a fix when the base rate is low. Tracker mortgage versus variable mortgage. A tracker is different from other variable rates, such as a discount, because it rises and falls in line with any changes in the index it is linked to, making it more predictable. A discount is usually linked to a lender, standard variable rate, SVR, so rises and falls if the SVR changes, which is at the lender's discretion. Rates on trackers are generally lower than SVR deals. These can change at the whim of the lender. How long do tracker mortgages last? If you are considering a tracker, you can usually choose a deal that has an introductory rate for a set amount of time. This is typically between 2 and 5 years, though some trackers are available on a 1-year basis. When that initial period comes to an end, you will likely be moved to your lender's standard variable rate, SVR. The rates for these deals are set by lenders and may roughly follow the bank rate, but they are not tied to it. They tend to be more expensive, so it makes sense to remortgage and switch to a new deal at this point, either a new tracker or a fixed-rate mortgage. As a borrower, you can also opt for what is known as a lifetime tracker. These mortgages track the bank rate for the whole term of the mortgage, and there is no set end date. You just need to tread carefully with this kind of deal, as it can be hard to predict what might happen to interest rates over a long period of time. Rates can also be higher than those on trackers with an introductory rate. How are tracker rates set? Tracker rates are set based on the movements of a specified interest rate, often the Bank of England's bank rate. Lenders usually add a fixed percentage to this to determine the tracker rate. So, when the bank rate changes, the tracker rate follows suit, either up or down. Nicholas Mendes of mortgage broker John Charcoal said, "Essentially, these deals track the base rate, but note that the actual rate you get depends on the lender's margin and your financial profile." Interest rate collar with a tracker mortgage. An interest rate collar is a kind of safety net. It sets both a cap, maximum, and a floor, minimum, on the rate you'll pay. This means your rate can go too high or too low, even if interest rates move dramatically. Mr. Harris said, "Collars, minimum rates you'll pay, became more attractive to lenders at a time when the bank rate fell to historic lows and in some circumstances became unprofitable for the lender. For example, Skipton Building Society has a product floor of 3%, so the borrower will not pay less than this, even if the bank rate falls below that. Bear in mind that while a collar is designed to give some predictability, it also means you might not benefit fully if rates drop significantly below the floor. Advantages. Trackers are transparent. Unlike some other types of variable rate mortgage, with a tracker you know exactly where you stand, thanks to the relationship between pay rate and index. Tracker deals typically do not have early repayment charges, ERCs, so there has no penalty for leaving early. This can make it easier to remortgage if you spot another deal you would like to secure. Rates can be cheaper than fixed-rate deals if other factors push up lenders' prices. Rates are generally lower than an SVR. Disadvantages. You need to be comfortable with fluctuating interest rates and the effect they'll have on your mortgage bills. Trackers are not suitable for nervous borrowers who cannot cope with potential increases. The total amount you pay each month could change, and it can go up. This is not great for those on a budget. You don't get the security that you would with a fix. You may not be able to borrow as high a loan amount as you could with a longer fix. If your deal has a collar set at your initial interest rate, you don't stand to benefit if the base rate goes down. Tracker mortgage FAQs. Can you exit a 2-year tracker mortgage? Yes, it is possible to get out of a 2-year tracker deal. With other types of mortgage, you would face an ERC for leaving during the initial offer period. These vary from one lender to the next and are typically a percentage of the outstanding balance. The difference is, trackers typically do not have ERCs. Mr. Harris said, "This is one of the reasons why borrowers find trackers attractive. If you want to leave early, you are likely to find no penalty is charged, other than the usual administration fee." Halifax recently, October 2024, dropped ERCs from all its trackers. The key is to check your mortgage offer to see if any restrictions or penalty charges apply. It is important to always weigh up the cost of exiting against the benefits of moving to a new deal. Should an ERC exist, it may reduce as you get closer to the end of the introductory period. Can I change from a tracker to a fixed rate? Moving from a tracker to a fix can be a good option when fixed rates have dropped, as this will allow you to lock in a lower rate. It can also be sensible if you are worried about rising interest rates and want the security of stable payments. Either way, it's vital that you do the maths to work out whether switching makes financial sense. Mr. Harris said, "If you want to move to a fix during the first couple of years of the tracker, there may be charges payable if your mortgage is not ERC-free. That said, some lenders, such as NatWest and Virgin Money, allow borrowers to change from a tracker to a fix without an ERC if you stay with the same lender. This is commonly known as a switch-to-fix facility and is treated as an internal remortgage." Mr. Harris added, "Should the tracker be ERC-free, then the borrower has the opportunity to fix with any lender and is not limited just to what the existing lender has available. Just note that the process may take longer. Is there a penalty for paying a tracker mortgage early? If you are able to pay off your tracker early, you need to check the terms with your lender, as some may charge a penalty for doing this. This will usually take the form of an ERC. These are often a percentage of your remaining balance. That said, many trackers are more flexible and may not include penalties. This is one of the big upsides of opting for this type of deal." Mr. Mendez said, "Always review your agreement carefully and weigh up the cost of any charges against the savings you could make by paying your mortgage off early." Are tracker mortgages available to first-time buyers? Yes, trackers are available to those taking the first step on the property ladder, provided you meet the lender's criteria. They can be an attractive option if you are comfortable with fluctuating interest rates, as they follow the bank rate. That said, first-time buyers tend to flock towards 5-year fixed-rate deals. Mr. Mendez said, "This is because lenders often use more favorable stress tests for 5-year fixes. This can allow borrowers to secure a higher loan amount compared to shorter fixed or tracker deals. Fixes can also be a better option for those on a budget." Mr. Harris said, First-timers may be less able to cope with interest rate fluctuations. Generally speaking, if you can't afford to be wrong, that is, if rates went up and you would struggle to pay your mortgage, you should opt for a fix. That way, you will know what your monthly payment is, even if it costs a little more initially for the security. Who is a tracker mortgage really for? So, after all that, who should actually consider a tracker mortgage right now? A tracker could be a great fit if you have a healthy cushion in your monthly budget. You've run the numbers and know you could handle your payments even if the base rate jumped by 1 or 2%. You have a stomach for risk and genuinely believe that rates are more likely to fall or stay flat in the near future. You need flexibility. Maybe you plan to move in a couple of years or expect a bonus you want to use to pay down your mortgage without getting hit by a penalty. However, you should probably lean towards a fixed rate if you're on a tight budget. If you're a first-time buyer and every pound counts, an unexpected payment hike could cause serious financial stress. The very thought of your mortgage payment going up keeps you awake at night. For many, the peace of mind that comes with a fixed rate is worth every extra penny. You have no plans to move or overpay. You just want to set your biggest bill and forget about it for a few years. Ultimately, choosing between a fixed and a tracker mortgage comes down to your finances, your future plans, and your personal tolerance for risk. There is no single best mortgage out there. The perfect deal for your friend might be a terrible choice for you. The important thing is that now you get it. You understand that a tracker's low starting rate is a trade-off for taking on risk. You know the questions to ask yourself about your budget and your nerve. Now this is just to get you started and shouldn't be taken as financial advice. Always speak to a qualified, independent mortgage broker who can look at your personal circumstances and help you find the right path. If this video helped you make sense of tracker mortgages, do me a favor and hit that subscribe button for more simple guides to navigating your home buying journey. And before you go, check out this next video on the biggest mistakes first-time buyers make. It could save you a ton of time, money, and stress. Thanks for watching.